All right, so we are on learning objective 8.2. We're going to do 8.2 and 8.3 together. So this is internal control over cash receipts. Cash receipts come from many different places when you're in business. It could, I mean, most of the time now we just have lots of electronic funds transfers, but we still have people write checks. Businesses are going to write checks because it's a good internal control feature to write checks, and not have cash laying around. You might have a cash register where you're like point of sale taking cash. You could have some cash being mailed to your mailroom. So there's a lot of ways cash can come to a business, but that just means there's lots of ways for cash to be stolen because cash is going to be the easiest thing to steal because you can hide it on your person. Some people don't go to that much effort. They just embezzle money out of a business one way or another. But cash is very important because we do not want to get our cash stolen. Okay. So when you do cash receipts by mail, you can see we have a mailroom here. The checks should go one direction and the remittance advice go to another. Okay. Treasurer needs to deposit the checks, goes all the way to the bank. The accounting department, these two are not joined. Notice that. Not the same. They are going to get that. They're going to make the entries. And then they're going to have a total amount posted to cash. And then the controller, both of those are going to go to the controller, and both of those totals should be the same. Okay. All right. We just went through that little diagram. They did such a good job on that. We don't think we need that. A lockbox system. This is where a bank is actually going to, or a bank employee is going to empty this box every day. So instead of you sending your check to whatever business you owe, that check is actually going to go to a bank, and then that bank will actually deposit the check into the business's account. It works out really good because it saves the middleman. You don't have to mail the check to somebody at the business, then somebody at the business going through all of that we just went through. It just goes straight into the bank. So it's a very good internal control because it keeps that check going just straight to the bank. Okay. All right, and we're going to look at internal controls over cash payments. One that I always like to throw out, there has been people who got fired from their jobs and somebody did not actually like go through the proper channels and that employee continued to get paid. That's really rough. If you forget to do that, that might be a mistake you don't make twice, or even once. You might have your job gone. Okay. Companies make a lot of payments by check because it is a good internal control, um, going both ways, receiving checks, writing checks. Okay. The check provides a record of the payment. It's going to have a signature on it by an authorized official. Um, there will be some supporting evidence, is reviewed prior to signing the check. So we got a little diagram here for cash payments. That's kind of a little hard for me to see there. Okay. So they had a purchase order, merchandise inventory, invoice, and then we had a check. Okay. We had the electronics manufacturer, we had Smart Touch Learning. They, sorry, I shouldn't have went over here first. Go over here. They have a receiving report, then a check is cut, and then it will go to the electronics manufacturer. Okay. So right here, we have we have this payment packet. We have a receiving report, invoice, and purchase order. Okay. Purchase order is sort of the business's approval to order something. Okay. A lot of vendors will not do any work until they get a purchase order. Um, they just make that a policy. Some of them might just do it based on the word of whoever is doing that, but most of the time they're going to get a purchase order. Then there's going to be an invoice and there's going to be a receiving report. And we want to make sure we got that receiving report is correct. Um, this is where inventory can get messed up really bad if it is items inventory isn't received correctly. Then it could go into the system and you have more inventory in the system than you really actually received. Okay, that makes your inventory all out of whack. Okay. Um, we have a lot of streamlined procedures now with all kinds of electronic funds transfers. And so, but even with all of that, a checking account is still vital to any business. If you start a new business of your own, just like sole proprietorship, then you probably need to go get a separate checking account for that to keep up with it. Okay. And do reconcile your checking account. We are going to do bank reconciliations in this chapter. I know a lot of y'all are like, I don't reconcile my account. I just look on my app. Yeah, you look on your app, but if you don't have a record, you don't know if the bank's made mistakes. And I have had, in my lifetime, I've had banks make mistakes that were not my fault. And therefore, I got out of any late fees or anything like that. Okay. All right. That is all for that video. We will pick up on learning objective 8.4 in the next video.